The California housing collapse just got worse in 2023, with the big trend now being declining inventory, with the number of homes for sale dropping by 23% year over year, the third biggest decline in America. And this declining inventory has been bad news for California home buyers over the last couple months. It means fewer homes available for purchase and more bidding wars, a situation which has now caused home prices to stop declining, with the state's home price declines year over year stabilizing at minus 4.4%. However, these price declines across California vary significantly depending on where you are. If you're in Southern California closer to San Diego, the prices haven't dropped as much. However, if you're up in Northern California near the Bay Area, the typical home price is down close to 10% year over year according to Zillow, with some zip codes near downtown San Francisco going down nearly 20% year over year. And I actually think those declines from Zillow are underestimating how much values have really dropped, because when you look at certain listings that are on the market today around San Francisco, you can see they are way down from what they used to be worth. With this two-bed, two-bath condo on the market for $899,000, down more than 25% from its value in 2020, and now matching what it sold for in 2017, over 6 years ago. So make no mistake, a lot of real estate wealth has been wiped out in California over the last year, particularly near the Bay Area. However, what I think is concerning a lot of California home buyers right now is they think the price declines are over due to the low inventory situation, because this low inventory is creating the perception of a strong housing market with lots of buyer demand this spring and summer, which is now causing prices to edge back up a little bit. However, I want you California home buyers to understand one thing very, very clearly, and that's that demand in the market is still near rock bottom levels. The California Association of Realtors reporting existing home sales are down 20% year over year and are hovering near their lowest level on record, comparable to what we saw in the beginning stages of the last housing crash in 06-07. And why is home buyer demand in California so low? Well, it's simple, folks. People cannot afford the crazy California prices mixed with 7% mortgage rates. For instance, if we look around Los Angeles and see what's on the market today, we can find a listing like this 3-bed, 2-bath that's on the market for $1.2 million is pretty typical for what a decent house in LA would go for right now. And you can see the estimated monthly cost for the home buyer of this house is over $8,000 a month, or nearly $100,000 a year in terms of mortgage, interest, and property tax, which is very problematic because the median household income in Los Angeles County is only $82,000 a year. That's right, folks. Data on Reventure app shows the median household income for every county in California and America more broadly, and you can see 82,000 in LA County, 108,000 in Orange County, and 100,000 in Ventura County. These incomes aren't high enough to support the current prices and payments, which you can see measured by a house payment to income ratio of 81% in LA, one of the highest in America, which makes very clear that anyone buying in California's housing market today, the very few buyers that they are not normal households. They are not people who make $80,000 to $100,000 a year, because you have to make 3 times that at least, like 300,000 to 400,000 in LA, to actually afford a house in today's market. And this lack of affordability permeates the entire state of California, with the house payment for mortgages and taxes as a percentage of income registering 66% across the state. That is insane, which is by far the highest in America. It's more than 10% above second place Montana, and is more than 3 times more expensive than the cheapest state, West Virginia, where local buyers can still pay only 22% of their income for a house. But here's the interesting question, everyone. With the affordability so bad in California, and with the home sales and buyer demand so low, why is it that inventory remains low? And why is it that prices started going back up this past spring and summer? Why does it seem like the housing market there is strong? And that has everything to do with what I call stubborn sellers. These are people who own houses across California who are currently refusing to list them for sale. With data from Realtor.com showing that new seller listings are plunging, down 32% year over year. New sellers coming to market with their house. That's well below the long-term average going back to 2016. You can see this plunge in listings started late last year and it's continued through the spring and summer. And so that shortage of listings is artificially propping up the California housing market right now and making it look stronger than it actually is. And this is a situation I don't believe is sustainable, folks, because eventually these sellers who are waiting to list, they're going to sell at some point, particularly as the economic downturn gets worse, particularly as people continue to run out of money in this economy. The personal savings rate is still near one of the lowest levels on record, just as the Federal Reserve increases interest rates further and takes money out of the economy. At some point, I believe we will see these sellers in California sell. And one tip-off that you should be looking out for if you're a home buyer and investor in California is watching the mortgage default rate across the state, because I think we will see a big surge in mortgage defaults in California. Because I want you to check this out, folks. Take a look at this graph, which is measuring the amount of mortgage debt by state. And what do you see? California has $2.3 trillion of mortgage debt. That's nearly 3 times second and third place Texas and Florida. Now, I know what people are saying. Well, California is the biggest state in America. Well, yeah, it is the biggest state in America, but it's not 3 times bigger than Texas and Florida. It's not even 2 times bigger than those states. California's population is only 25% more than Texas's, but yet its mortgage debt is 3 times higher, which is a signal that yes, we will see mortgage defaults and forced selling at some point in this California housing cycle. And I can't tell you when exactly that's going to be. It's likely going to have to align with an increase in the unemployment rate, which is currently sitting near a record low 4.6% in the state of California, which is not going to sustain itself. Because if we look back at the historical economy in California, what do you notice, folks? Every recession, pretty much, the unemployment rate in California historically gets close to 10%. And so we're going to see this unemployment rate go up in California, which is going to cause these very low mortgage default rates currently to go up further, which is going to put more inventory on the market. And when it does, home buyers are not going to be there to absorb the inventory at current prices and mortgage rates, because they literally can't qualify for loans at this point to buy houses, given how bad the affordability is. Because I want to show you guys some more cities in California and how these cities are trending, with one such area being Sacramento, where the typical home value across the metro is a massive $564,000. For perspective, that's almost 20% more than Austin, Texas. And those expensive prices in Sacramento are in a city and metro that doesn't really have a whole lot going on. I mean, Sacramento is basically a glorified bedroom community to the Bay Area, and its housing market runs off people leaving the Bay Area. And so as prices in the Bay Area go down more, we're probably going to see fewer buyers enter the Sacramento housing market, which will push down demand and cause inventory to go up and prices down into the future. However, right now, things are still very unaffordable there. For instance, if you look on Zillow at the listings in Sacramento and go east to a suburb called Carmichael, you can see that there's a 2-bed, 2-bath house that's 960 square feet on the market for $500,000. And yes, this is a recently renovated house that looks decent. However, it's priced at $521 per foot, a level which is almost double what it was worth in 2019, and where the buyer would need to pay $3,300 a month in their mortgage, taxes, and insurance. And so that lack of affordability, I think, is going to drive prices down further in Sacramento in the long run. I know in the short term, inventory is low. It seems like there's buyer demand, but there really isn't. And once the stubborn sellers in the area eventually get to selling, either on their own volition or through mortgage defaults, I suspect prices in Sacramento will go down by more. But folks, another area in California we need to talk about is a little bit further south of Sacramento in the Inland Empire. Well, let's talk about what is going on in the Riverside and San Bernardino housing market. Well, prices here are down by about 4% year over year, a little bit of a correction so far. And ultimately, what concerns me about these areas is how historically volatile they are. So you can see this initial correction in 2023. Yeah, it's not that much, but pay attention to what happened between 06 and 07, everyone. There was an initial correction. People said, oh, it's not going to be that bad. And then bam, prices went down by 50% over the next couple years in Riverside. And one of the reasons Riverside got hit so hard in that last downturn is because its economy got absolutely destroyed, with the unemployment rate going all the way up to 15% in 2009, everyone. And that wasn't the only time it went to double digits. It also hit 11% in 1992-93. Where is it today? Well, it's 4.5%, still near a record low and likely to surge way up into the future. So I want you folks to think about something. If you're a buyer in California, do you think this situation of a record low unemployment rate mixed with record low inventory and sky high prices is stable or sustainable? I mean, I don't, folks. I mean, it's very clear to me that record low unemployment rate and record low inventory is the only thing that's keeping sky high prices from going down further. And when those shoes inevitably drop, the prices are going to go down. Now, of course, there's lots of people who disagree with me. More and more people are out there in the economy, whether it be California or America at large, saying there is no recession, there is no downturn, we're in a soft landing, we're in the Goldilocks scenario. And folks, if you are someone who thinks that, you're entitled to your opinion, but I just want to let you know, if you think that and you're predicting that, you're essentially predicting something that's never happened before in US history. And that's a very speculative thesis to have, to say that something that's never happened before in US history is going to continue into the future unabated, with interest and mortgage rates surging, with the personal savings rate near a record low, with home buyer demand near a record low. Those are all indicators that eventually we are going to see this recession that me and others have been predicting for a while come to fruition. But of course, if you're a regular home buyer, you might be tired of waiting for this recession and downturn. You might have already been waiting 2 to 3 years to buy a house. So what should you do if you're someone, whether it be a buyer an investor who's been holding out for years and years and you're getting fed up? Well, the first question you should ask yourself is number one, can you afford to buy a house in today's housing market? Especially in California, like, can you actually afford it? What percentage of your gross income is going to go towards those mortgage payments, property taxes, and insurance? Is it going to be 50%? Is it going to be 45%? I expect for a lot of you watching this, it will. And if that's the case, you just got to understand that it's very risky to buy into that situation and ultimately become house poor. Lots of the buyers who are buying in today's market are becoming house poor, meaning that they might actually have a decent amount of money, but all that money is getting spent on the house, and thus they actually feel poor and they're having to cut back their spending in other areas. That's not a situation I would want to be in. So you got to ask yourself that question. And then number two, you got to ask yourself, what is your risk tolerance? Are you okay conceptually with buying in today's market, getting the house and living in it, and then seeing the value of that house decline by 20% over the next several years? Is that something that's going to completely melt your mind and entice you to want to sell at the worst possible time in a down market? If so, you probably shouldn't buy today. However, if you're someone who's saying to yourself, well, I'm going to live in that house for 10 to 15 years, I don't care if it goes down by 20% over the next couple years, well, then maybe it would be okay to buy a house in today's market. However, if it were me, I'm probably not buying in California right now, especially not in a metro like San Diego, which is pegged at 18% overvalued on ReVenture app with a typical home price today of $879. The fair value price in San Diego is $721, indicating more downside to go. However, the frustrating thing for buyers in San Diego right now is this low inventory. Back before the pandemic, there was 6,000 to 7,000 homes on the market in San Diego County. Now that's down to 2,300, with this low inventory now causing monthly home prices to start trending back into positive direction. But again, you have to wonder how sustainable that is. San Diego's home buyer affordability is some of the worst in America, with houses like this being priced at $935,000. And actually, now the seller just increased the price on this by 10 grand, which is almost like adding insult to injury here. For a 1,500 square foot house, it would cost you $6,400 a month to own in today's market. But one thing you guys have to understand is that it's not enough to know about what's going on in your metro and your county if you're a home buyer. You got to understand the trends in your zip code. Particularly, look at statistics like what percentage of sellers are cutting the price. If you understand that statistic, which I call price cut percentage in your neighborhood, you're going to know a lot about the direction of your housing market and whether you're going to face a bidding war or whether you're going to have an easier time buying a house and get a good deal. We can see, zooming in on San Diego, that there's big differences in price cut percentage in different zip codes. For instance, if we go out east here to these suburban zip codes, price cut percentage is 0 in 91935. It's 5% in 91901. Very few price cuts here, meaning lots of competition. However, you zoom in more on urban San Diego, 26% price cuts, 32% price cuts in Hillcrest. So more motivated sellers in these areas in red. And in particular, you want to look at what this price cut percentage looks like over time. So in Hillcrest today, in 92103, it's 32%. That's way higher than it was in previous years. And it's actually the third highest level on record going back to 2016. And so that's a sign that prices in this neighborhood will likely decline more into the future. Whereas this neighborhood in 92040, well, it has a 0% price cut share this year compared to 33% last year. So big difference in this market, very competitive. It's likely the prices either stay flat or keep going up the next 6 months. And being armed with that knowledge about your zip code and neighborhood is so important if you're a buyer, so you avoid being frustrated and caught off guard by what's going to happen when you go to an open house and make an offer. Make sure you know that price cut percentage for your neighborhood and your zip code before you go to the open house and before you make an offer. To look up that data, go to www.reventure.app and then change the data point to price cut share, then hit zip code, type in your metro, and take a look at all the huge differences that exist in your market.